So what is the best investment ever? And because I'm a savvy YouTuber, I'm gonna gatekeep all of the information until the end of the video and talk about something completely different. No, not really. I'm gonna tell you now, it's real estate, but in the video, I'm gonna at least tell you why. What's up? My name's Avery. I own over $3.5 million worth of real estate, and it's a vehicle that has allowed me to become financially free. And in today's video, I'm gonna go over 7 reasons why it's the #1 investment for you out there. And I really don't like to waste a bunch of time. I like to get straight to the point and give you great information. So we're just gonna hop in right to the first one. And that first reason why real estate is a great investment would be leverage. Now, leverage can be seen as a very good or bad thing. If you're Dave Ramsey, it's a terrible thing. And if you're someone who likes Dave Ramsey, it's also a terrible thing. But if you actually know what you're doing with your money and you like to make money, leverage is a fantastic, wonderful thing. And leverage in finance is really just a fancy term for taking on debt. Now, there's a ton of bad debt out there, but there's a lot of good debt out there too. Bad debt can be things like credit card debt, personal loans, potentially student loans, depending on the type of degree or education that you received. But the lots of good debt out there can be seen in things like a mortgage. And not just a mortgage on your primary home where you're living in a property hoping that it appreciates but spending a ton of money on it and actually losing money, but even the entire time being told it's the best investment you can ever make. But if you flip that on its head a little bit, get a mortgage and then rent out your property and have other people pay it for you, this is a fantastic use of that debt. And in many other forms of investing that are traditional, like stocks or crypto, leverage is a lot harder to be able to get because you could potentially get a loan and buy those kinds of things, but you could be margin called on, essentially, where if the stock gets to too low of a price, you have to owe the entire amount of loan that you paid back, whereas that's not nearly as true in real estate. In real estate, you could buy a $500,000 property and it could be completely rented out and you could make money on that property and it could go lower in value, but that doesn't mean you have to pay back your entire loan. As long as you can get through the periods of the negative downturns back to the positives while still paying off of that mortgage, you can hold on to that property for a long time. And it's also a lot easier to acquire a loan for a rental property or a house than it would be for stocks or crypto. Leverage and taking on good debt is awesome because, like for me, I bought a $525,000 property with a $65,000 a year salary and only an $18,000 down payment. The fact that I can buy a $500,000 asset with $18,000 is absolutely wild. And today that property is over 40% equity. But in today's market, I want you to be extra careful with leverage. Make sure you have solid cash reserves when you buy a property, just so that you can get through any periods of economic negativity. Even if you put 3.5% down and the property goes down and you're technically underwater on your mortgage, that can be okay as long as you can pay off that mortgage and wait for the property to go up in value because you bought in a good location and you have solid tenants and know that it's a winning investment in the long term. The second reason why real estate is a fantastic investment is because of cash flow. Cash flow is going to be that thing that actually enables you to retire, achieve financial freedom, and live off of your investments instead of having to work your entire life. With stocks and crypto, this is technically achievable. With stocks, the example would be something like a dividend. But typically with dividends, let's say you want to get a livable salary of roughly $40,000 a year, you might need an over $1 million portfolio. If you want to make $40,000 a year from real estate, you can get that $1 million amount of assets, but it's going to cost you a lot less than a $1 million to actually acquire those assets because of the first reason, leverage. So this is very cool. You've bought a property, you have a mortgage, someone is paying you rent that is covering your mortgage and covering all of your expenses, plus giving you a little bit of profit. And if you want to get comfortable with being able to analyze deals, check out the link in the description below where you can check out my rental property cash flow calculator so you can be confident when you're actually underwriting deals to make sure that they make sense. The next reason would be appreciation. Now, this might not necessarily happen everywhere you buy a house. Just because you buy a property does not mean it will go up in value. I think this is one of the biggest fallacies and mistakes that people make because they just assume you buy a house that it's going to go up in value. Now, this might have been true if you bought, for example, in the 60s in San Francisco, obviously went up a ton in value. But there's a lot of places all over the world and country that not necessarily went up in value whatsoever. You can buy a property, it can be stagnant, or it can cost more money to maintain that property if it's just a primary home than the amount of appreciation that you could receive. But typically, real estate will go up at roughly a 3% per year. But that 3% is really awesome because the amount of money that you had to put down to get that appreciation is a lot less. So if you bought a $100,000 property and it goes up to $103,000 in 1 year, that doesn't mean that you really earned 3% because it only took you let's say $5,000 to acquire that property, and you've now turned your $5,000 into $8,000 because it's gone up by 3%. So that's a huge amount of appreciation on the amount of money that you actually put down. So you're able to acquire this property with less money. It can bring you in money every single month if you're renting it out, and then it will also increase in value, and you have the opportunity to force appreciation to it by renovating it and making it look like other properties, because you bought a property that's under a little bit of distress and needs some love so that it can be worth more and more money. And this is very cool. For example, I bought an Airbnb earlier in the year, $405,000, a little bit dated, full of red carpet from the 90s, all of that cool stuff. And I took all of that out, spent $50,000, and I paid someone to do all of this to fix it up. And now the property is worth roughly 525 grand. So I turned that 50 grand and essentially just doubled it by renovating a property. The fourth awesome benefit that a lot of people really don't talk about would be principal pay down. So every single month when you're paying that mortgage, and because your tenant's paying that mortgage, they're paying it for you, the amount of loan that you owe will go down. And that really is what principal pay down is. Yes, there's a lot of interest on your loan, there's taxes, there's insurance, and some unrecoverable costs, but someone else is also paying those. So not only, let's say you get $500 a month in cash flow from your property, but let's say your mortgage is $2,000 and $600 of that every single month goes towards paying down the principal. So not only are you getting positive $500, but your loan is going down by $600 and you didn't pay it. So that's an $1,100 positive amount of money every month just from getting paid to have a home. Now, I think that one's pretty simple and self-explanatory, and obviously the larger the loan size and the lower your interest rate, the bigger the amount of principal payments will be. And the way mortgages work, you pay most of the interest in the first 15 years. So over time, that principal payment will get larger and larger, and the interest payment will get smaller and smaller. So at the very beginning, you may not get as much principal pay down as you would say in year 20. The next awesome benefit about real estate, and this one is amazing, are all of the tax benefits. The two major tax benefits would be depreciation as well as deductions. So when you own a property and you do capital improvements to it, or you own an Airbnb and you buy furniture or supplies, you can deduct those things from your overall cost basis so that you can lower the amount of income that you're receiving. Just like a business, if you have a car that you need to drive around, or you have a fancy camera in hopes that people will like your video on YouTube, you paid for those things and they're considered business expenses. So if you change out your roof on your property, you update a hot water tank, you do some renovations, all of those things are deductible, and meanwhile you've done them, the property value has also increased. But in the eyes of the IRS, every single year your property actually goes down in value. This would be known as depreciation. So you're able to depreciate the cost of the building over a useful life and other types of techniques. Talk to your CPA about that kind of stuff. But typically when you sell the property, you'd have to recapture and pay all of that depreciation back. But because real estate is really awesome, you can do a 1031 exchange, which is another awesome tax benefit to basically take the profits and that depreciation recapture into a new property and then not have to pay it then, and then just keep doing it. And then once you die, pass your properties onto your heirs, and then they have a step up basis, so no one actually ever pays it ever at any point. I won't get too deep into that last little thing about 1031 exchanges, but if that interests you, let me know in the comments down below and I'd be happy to make a more thorough video on it. So the next thing I want to talk about would be tapping into your equity through either a cash out refinance or a home equity line of credit. So as you own this property, you're receiving cash flow every single month, the principal is going down, you're building more and more equity because it's appreciating, so you have this chunk of equity that feels like it's stuck in the home, but you could do a couple of different transactions, either that HELOC or the cash out refinance, and take that money and invest into more real estate and get all of these same benefits all over again. A home equity line of credit is like a credit card for your property. You basically can get up to a certain amount of equity that you have in your property as a line of credit from a bank, and then you can take that money, just the amount that you've drawn on, similar to a credit card, and then you pay it off slowly over time, but not like a credit card where it earns really high interest. HELOCs or home equity lines of credit will have somewhere between like a 4 to 8% rate, and it is variable with whatever's going on in the market. And HELOCs are cool because it's interest only payments for 10 years, and then you could get a new HELOC to cover that HELOC. But if you ever sell the property that's associated that has that home equity line of credit, then you have to pay that back in due at sale. And typically it's a lot harder to get a home equity line of credit on an investment property. It's most likely going to be something that you get on your primary home. The other thing that you can do is a cash out refinance. So let's say the 40% equity I have in my duplex, someone will allow me to have to keep 30% equity in my property. So 10% of my now $800,000 property is $80,000. So I could pull $80,000 out of my property, increasing my loan from, let's say it's at 500 to 580. So my payment would increase. It would change to the interest rate of whatever is going on in the environment right now, but I would get a check for $80,000 that I could take and do whatever I want with it, most likely invest in more real estate and make more money. The last thing that is awesome about real estate and a great benefit would be control. You have a lot of control over what you can do with that asset. You could rent it out on Airbnb, you could rent it out to traveling nurses, you could do a long-term rental, you could move into it yourself if you wanted to waste a bunch of money and not actually make any. You have a lot of control over it. You can also add additions based on certain zoning and rules in your county or in your city or wherever jurisdiction that you're in. You can also sell it if you really needed to, but you have a lot more control over it than you would, let's say, a stock. Let's say you buy a stock within Apple. You don't really have any control over what Apple is going to do. You might believe in that company and the stock value will go up, but it's not the same way that you could buy a distressed property and do a bunch of renovations to it and know that the property next door is worth this much, so you just make your property worth that much and fix it up to that ability, and now you know that your property is going to be worth that much, and then you have an awesome cash flowing property that looks pretty and something that will help you retire, unlike relying on Tim Cook doing a good job in making sure stock values go up. So that's it. Those are the 7 awesome things about real estate, and there were a couple more sprinkled in there underneath each umbrella category. And if you guys like that video and want to learn more about investing in real estate and what strategies you can do and how you can actually pull it off to achieve financial freedom, definitely hit that subscribe button, because I'm always talking about investing in real estate and I'm always doing it myself. And if you guys like that video, definitely hit the like button if you haven't already. And if you like me here, don't forget to check me out on TikTok and Instagram, where I make a lot of content daily as well. So thanks again for watching, and more wealth is coming your way.